everyone, and welcome to this deep dive
Yay.
into deciding between Cava and Realty Income.
Oh, this is a good one.
Yeah, I'm excited about this one. So many people are asking, should they put their money in this hot new restaurant stock or go with something more established like a REIT?
Right.
And it's a tough choice, right? You want growth, but you also want to be smart, especially with how, the market's been.
Yeah, exactly.
So we're going to try to break it all down.
Yeah.
So starting with Cava, their growth has been insane. Like 300% stock increase in a year.
It's unbelievable.
It's really crazy.
It is. And, 18% same-store sales growth last quarter. That's unheard of in the restaurant industry.
Yeah. Usually you're happy with 3 to 5%.
Yeah, like low single digits is considered doing well.
Right.
Yeah.
It really does feel like, the early days of Chipotle.
Right.
They only have 352 locations right now compared to Chipotle's 3,600. So tons of potential.
Yeah, there's a lot of room to grow.
But, and this is a big but, all that hype has also driven their valuation way up.
Oh, yeah.
Their price-to-earnings ratio is 340.
That's a lot of optimism baked in there.
Yeah, could you explain what that means for anyone who might not be totally familiar with a price-to-earnings ratio?
Yeah, so basically it means for every dollar that the company earns, investors are willing to pay $340 for a piece of that.
Wow.
It's a bet that the company is going to keep growing like gangbusters.
Right, but things can change fast, especially in the restaurant business.
Oh, absolutely.
Look at what happened with Red Lobster, filing for bankruptcy.
Yeah, earlier this year it was one of the top restaurant bankruptcies.
It's a good reminder that, nothing is guaranteed.
Yeah, the restaurant industry is tough.
So with Cava, it's they need to keep hitting those crazy growth numbers.
Yes.
Otherwise, that stock price could fall pretty hard, right?
Exactly. There's a lot of pressure on them to deliver.
And it makes you wonder, what if they don't become the next Chipotle?
That's the big question, isn't it?
It is. Okay, so we've talked about Cava. Now let's look at Realty Income, which is a totally different animal.
Totally different.
They're a REIT, so they own and lease properties.
Right.
And here's the interesting thing. 73% of their rent comes from retail spaces.
Which, if you think about it, is kind of connected to the restaurant industry, too.
Yeah.
Because they do lease to some restaurants.
Right, but they're not betting on just one or two companies.
Exactly. They have over 1,550 tenants. So they're very diversified.
It's a different approach.
It is. They're not looking for explosive growth.
Right.
They're looking for slow and steady income.
Yeah.
And that can be really appealing for investors who are looking for stability and dividends.
Yeah, their dividend yield is 5.5%, which is pretty good.
It is.
Plus, they've increased their dividend every year for the past 30 years.
That's consistency you don't see very often.
It's really impressive.
It is.
So for someone who, maybe thinks Cava is a little too risky, Realty Income offers a way to kind of get into that retail space, but without putting all your eggs in one basket.
Yeah, it's a way to play the trend if you believe in the long-term strength of retail.
Okay, so we've laid out kind of the two different approaches here.
Two different philosophies.
Yeah. Now let's get into the nitty-gritty. Let's talk about some of the risks and challenges that each company faces.
All right, let's do it.
So starting with Cava, they've been growing like crazy.
Right.
But can they keep it up? What are the chances that they'll actually become the next Chipotle?
That's a great question. And honestly, it's impossible to say for sure.
Yeah.
But we can look at some of the factors that might affect their growth.
Okay, so let's do that.
All right, let's break it down.
So while Cava offers that exciting high growth potential, it comes with a lot of uncertainty. Maybe for someone who's looking for more predictability in this market, especially with all the ups and downs we've been seeing, a company like Realty Income with its steady dividends and that diversified portfolio we talked about might be a better fit.
It's a good point. The desire for stability is something a lot of investors are feeling right now. And you're right. Realty Income does offer a sense of reliability that's especially attractive in a volatile market.
Okay, so we've got the tortoise and the hare, the steady versus the speedy. And I'm curious, what are your thoughts on how inflation, which has been a big concern for everyone lately, might impact each of these companies?
That's a key question, and it's one that really gets to the heart of how different these two companies are. For a restaurant chain like Cava, high inflation presents a real dilemma. On the one hand, they need to raise prices to keep up with rising costs for ingredients, labor, everything. But on the other hand, if people are feeling financially squeezed, they might start cutting back on things like eating out.
So inflation could actually hurt Cava's growth, even if they're doing everything else right.
That's the risk. If people are tightening their belts, those impressive same-store sales numbers might start to level off. And remember, Cava's stock price is based on the expectation of continued aggressive growth. If those growth expectations aren't met, well, their stock could take a hit.
That's a sobering thought. But what about Realty Income? How do they handle an inflationary environment?
Realty Income actually has a couple of things working in their favor when it comes to inflation. First, as we mentioned earlier, a lot of their leases have those built-in rent escalations that are linked to inflation. So as inflation rises, their rental income goes up too. It's like a built-in protection mechanism.
That's a clever strategy. It's almost like they anticipated this kind of economic climate.
And the second advantage for Realty Income is that REITs, in general, are considered to be a good hedge against inflation. This is because the value of their underlying assets, real estate, tends to go up during inflationary periods. So even if their tenants struggle a bit, the value of the properties they own is likely to hold steady or even increase.
Okay, so Realty Income sounds like it might be a bit of a safe haven if you're worried about inflation eroding your investments.
It could be, but let's not forget, a big chunk of Realty Income's portfolio is tied to retail, and the retail landscape can be pretty unpredictable. We've seen so many changes in recent years with the rise of e-commerce and changing consumer habits.
That's true. It seems like every week we hear about another retailer struggling to stay afloat. So how can Realty Income be sure their retail tenants will survive, especially if we're heading into a period of economic uncertainty?
You're right to point out those risks, and Realty Income is very aware of them. They've actually been adjusting their strategy to address these challenges. One of the things they've been doing is increasing their exposure to non-discretionary retail.
We talked about that a bit earlier, but can you remind me what exactly that means?
Sure. Non-discretionary retail is basically businesses that sell things people need regardless of their financial situation. Think about grocery stores, pharmacies, drugstores, even dollar stores. These are the kinds of places people will keep shopping at, even if they have to cut back in other areas.
So they're shifting away from the more traditional retail that might be vulnerable to economic downturns and focusing on the essentials.
Exactly. It's a way for them to make their portfolio more resilient in the face of economic uncertainty. They're trying to stay one step ahead of those potential risks.
That makes a lot of sense. But even with those efforts, there's still the possibility that some of their tenants could go under.
It's true. No investment is completely risk-free. But remember, Realty Income's diversification strategy is all about mitigating that risk. They have so many tenants that even if a few don't make it, the impact on their overall portfolio is likely to be limited.
It's fascinating to see how Realty Income is adapting to this evolving retail landscape. It's like they're constantly analyzing the market and making strategic moves to protect their investors.
Absolutely. And it highlights an important point for anyone who's investing. You need to do your research and understand not just the individual company you're investing in, but also the bigger picture, the industry trends, the economic environment, all those factors that can affect the company's success.
So it's about connecting the dots.
Exactly. And that's where a deep dive like this can be so valuable. It helps you connect those dots and make informed decisions about where to put your money.
So we've talked about inflation, we've talked about the risks and rewards of each company, but I'm still curious, knowing what we know now, if you had to choose, would you put your money in Cava or Realty Income?
That's the million-dollar question, isn't it? And unfortunately, there's no easy answer. It really depends on your individual circumstances, your risk tolerance, and your investment goals.
Okay, but let's play a little game here. Pretend you're an investor who's looking for long-term growth, but also wants to sleep well at night, knowing your investments are relatively safe. Which way would you lean?
That's a tough one. But those were my priorities. I'd probably lean towards Realty Income. Their track record of steady dividends, their diversification strategy, and their focus on essential businesses make them a compelling choice for someone who prioritizes stability and long-term growth.
That's a fair assessment. And honestly, I think I might agree with you. Cava is exciting, but it's also a bit of a gamble. Realty Income feels more like a solid foundation you can build your portfolio on.
Exactly. It's like building a house. You need a strong foundation before you can start adding those fancy features.
I love that analogy. It's a great way to think about portfolio construction. You need that balance of stability and growth.
Absolutely. And it's important to remember that you don't have to choose just one or the other. You can diversify your portfolio and own most types of companies.
That's a great point. You could have a portion of your portfolio dedicated to steady income-generating investments like Realty Income, and another portion dedicated to higher growth, potentially riskier investments like Cava. That way you get the best of both worlds.
Precisely. It all comes down to finding the right mix for your individual needs and goals.
So we've talked about risk, we've talked about inflation, and we've even touched on portfolio diversification. But there's another factor that I think is important to consider, and that's interest rates. They've been on the rise lately, and that can have a big impact on investments, especially REITs like Realty Income.
You're absolutely right. Rising interest rates can create some headwinds for REITs. One of the ways it impacts them is by increasing their cost of capital. REITs often use debt financing to acquire properties, and as interest rates rise, the cost of that debt goes up, which can eat into their profits.
So rising interest rates could potentially slow down Realty Income's growth.
It's a possibility. And it could also put pressure on their ability to increase their dividend in the future. Remember, investors love Realty Income for those consistent dividend payouts, and if those dividends start to shrink, it could make the stock less attractive.
That's something for investors to keep an eye on. It seems like even with a company as stable as Realty Income, there are still risks to consider.
Of course. There's no such thing as a risk-free investment. But that's why it's so important to do your due diligence, to understand the company, the industry, and the broader economic environment before making any investment decisions.
Well said. Knowledge is power, especially in the world of investing. And I think we've given our listener a lot to think about today.
I hope so. We've covered a lot of ground, and I think we've provided a solid framework for understanding the key factors at play when deciding between a company like Cava and a company like Realty Income.
You know, one of the things that struck me during this conversation is how even seemingly unrelated factors, like rising interest rates or inflation, can have a ripple effect across different industries and different types of investments.
That's the beauty and the complexity of the market. Everything is interconnected.
It's almost like we've zoomed out from just looking at these two companies to seeing the whole economic landscape.
Exactly. And that broader perspective is so important for making smart investment decisions.
Well, I think we've successfully zoomed out and zoomed back in again. We've examined Cava and Realty Income from all angles, and I'm feeling a lot more informed. What about you?
Absolutely. We've dissected their business models, we've analyzed their strengths and weaknesses, and we've explored how external factors like inflation and interest rates could impact their performance. I think our listener has all the information they need to make an informed decision.
Okay, before we wrap up this part of our deep dive, I want to circle back to something we touched on earlier, Realty Income's diversification strategy. They have over 1,550 tenants, which is impressive, but how do they choose those tenants? Is there a method to their madness?
It's not madness at all. They have a very deliberate and sophisticated process for selecting tenants. Their goal is to create a portfolio that's balanced and resilient, one that can weather economic storms and generate consistent income over the long term.
So what are they looking for in a tenant?
They consider a variety of factors, including the tenant's financial strength, their industry, their track record, and their lease terms. They also look at the location of the property and its potential for appreciation. It's a holistic approach designed to minimize risk and maximize returns.
So they're not just throwing darts at a board. They're carefully analyzing each potential tenant to make sure it's a good fit for their portfolio.
Exactly. It's a very data-driven process, and it's a key part of their success.
So they're doing their homework, and I guess that's a lesson for all of us as investors, right? We need to do our homework too.
Absolutely. Whether you're considering a high-growth company like Cava or a more established company like Realty Income, the key is to understand what you're investing in, why you're investing in it, and what the potential risks and rewards are.
I think that's a great place to pause for now. We've covered a lot of ground in this section of our deep dive, and I think we've given our listener plenty to think about.
I agree. It's time to let those insights sink in.
All right, so we spent a lot of time with these two companies, Cava and Realty Income. And I feel like we've gotten a really good sense of how different they are.
Yeah, two totally different approaches.
Yeah, like high growth versus stability, all that good stuff.
Right.
But I think the really cool thing is that even though they seem so different, they're actually connected in a lot of ways.
Absolutely. Like through the retail sector, the economy as a whole.
Yeah, exactly.
It shows how important it is to have that big picture view when you're investing.
Right. You can't just focus on one little piece.
Exactly.
You got to see how everything fits together.
You got it.
So for our listeners who are trying to decide between these two companies,
right,
what are some key things they should be talking about?
Well, first and foremost, you got to think about your own personal risk tolerance. Are you comfortable with a little bit of a roller coaster ride? Because if you're investing in Cava, that's what you're signing up for.
Right, because it's a risky bet.
It is, but it could also pay off big time.
Yeah, if they really do become the next Chipotle.
Right.
But if you're more risk averse, if you're looking for something more stable,
Then Realty Income is probably a better fit.
right, they're not going to make you rich overnight.
Probably not.
But they're going to give you that steady income and hopefully some growth over time.
Exactly. Slow and steady wins the race, as they say.
Right. And, even if you decide that Cava is too risky for you,
Yeah,
it's still worth paying attention to how they're doing.
absolutely.
Because their success or failure could tell us a lot about the future of the restaurant industry.
And that could impact Realty Income down the line.
It's all connected.
Everything is.
So, any final words of wisdom for our listeners before we wrap up this deep dive?
Yeah, I'd say the most important thing is to do your research. Don't just jump into something blindly.
Right.
Understand the company, understand the industry, and make sure you're comfortable with the risks.
And be honest with yourself about your own investment goals.
Absolutely. What are you hoping to achieve with your investments? Once you know that, you can start to build a portfolio that makes sense for you.
Well said. I think that's a great place to leave it. Thanks for joining me on this deep dive.
It was my pleasure.
And to all our listeners out there, thanks for tuning in. We hope this has helped you make some informed investment decisions.
Happy investing, everyone.
Until next time.